Kristina, I'll start with you, and I want to just get your initial gut reaction here to some of the moves that we saw this week.
Well, my gut reaction is that we probably should have expected this. What we're doing is going through a digestion period, a terrible digestion period that's likely to result in ulcers, but a digestion period nonetheless. And that's because, and really it started with the unofficial start of tightening season when we got the December FOMC minutes a couple of weeks ago. That told us the Fed had made a hawkish pivot. And then everyone scrambled to figure out what that exactly meant. And imaginations ran wild. Could be 8 rate hikes this year. And then we heard from Jay Powell this week. And while he certainly tried to soothe markets in some ways, he was very clear that the Fed is comfortable doing more this time around because the economy and labor market is in better shape. And so that has
Yeah.
continued to cause fear and creating a re-rating among stocks, especially higher valuation ones.
Well, Jurrien, let's talk a little bit about what people are re-rating here. I mean, we've seen some pretty wild expectations for what the Fed might do, from 2 hikes to as many as 6 this year here. What are people positioning themselves for right now?
Well, I mean, there's a couple of elements to this. First of all, the rotation out of the high-flying sort of meme stocks, non-profitable tech, et cetera, that already began a year ago. So we're actually already a year into a rotation on the expectation that we're going from a year last year of a trifecta of tailwinds, right? 48% earnings growth, abundant liquidity from the Fed and from the fiscal side, very low nominal rates, negative real rates. We're losing 2 of those 3 pillars, if you will, and it's all up to earnings growth. And if you're a stock and you don't have solid fundamentals, you're not going to this is not going to be the year for you. And then the other element is that interest rates were pretty significantly repressed last year, and they still are to some degree through quantitative easing. And that has a direct transmission mechanism into the valuation side of the equity markets, right? If you plug that into a DCF, it added about 5 PE points to the S&P.
Well, I am curious, Jurrien, about earnings estimates, because we haven't, at least from some of the sell-side analysts that we track here at Bloomberg, they haven't necessarily come down, at least in aggregate, quite yet here. And I'm wondering if we still need to see, I guess, a little bit more capitulation with regards to folks' expectations about aggregate earning growth on the S&P 500.
Well, the estimate, the consensus estimate, which I get from Bloomberg every Friday, is for 2022 is now about 7.9%, I believe. That's about 100 basis points less than it was 4 weeks ago. So the numbers are coming down. But even if it goes to 7 or 6 or 5, obviously that's a far cry from the 48% we got last year. So earnings growth clearly is decelerating at the same time that the Fed obviously is accelerating its normalization process. And whether we get 4 or 5 or 6 hikes in 2022, I don't think is really the most important thing. I'm more concerned about where the cycle ends than how and when it begins. And it's interesting that despite all the hawkish job owning from the Fed over the past month or two, that neither the Fed funds rate nor the Eurodollar curve is pricing in a terminal point of the cycle above 2%. So the expectations of how the cycle begins have been ratcheted up, but the expectations of how it ends have not really changed, even though the Fed is moving the goalposts here.
Kristina, how do you measure the communication so far from the Fed, to Jurrien's point, about how long this tightening cycle might be?
Well, I think what the Fed is trying to do is talk very hawkish, scare markets. That helps in doing some of the heavy lifting. And then it can certainly, hopefully, be a bit more dovish when it actually happens. I also think there's an element of this. Conventional wisdom suggests that if they do it sooner, then there's less to do in total. And that's why we haven't seen much of a change in the terminal rate, because our expectations have changed about when the Fed's going to start and how many rate hikes we're going to see this year.